It's 24 degrees today. It's not snowing, but by Thursday, it'll be a low of 6. Do you think I enjoy being here, or is Detroit that much better?
I mean, it's not that different. I'm on the other side of the lake though, so you get like all that lake effect stuff, and we don't hear so much on the east side of the state. But you know what's crazy is you had that big snowstorm over the weekend. We got just like dusted. This morning I had more snow than I did over the weekend. So after I had my coffee, went out and shoveled the snow some, and I'm actually running a little bit low on my salt supply for my driveway, so I definitely got to pick up some more after the
You go
close
pick it,
today.
what, you get it at Home Depot or Lowe's, or you get it at some local place like Menards?
No, let me tell you about my local hardware store. It is probably one of the hidden gems of America. It is so I live here in this like small town community here in Southeast Michigan, and they have this hardware store. It's been around, I don't know, like decades and decades. It's locally owned, and just a regular hardware store. They also sell liquor, but they also sell firearms too. So it's like a one-stop shop where you can buy hard liquor and firearms in the same location. It's not you don't see that very much anymore, but it does still exist.
Is it just me, or is that a bad combination? Liquor and
It's
alcohol
it's
going
yeah,
together?
it's a
Has that ever
remarkable
been a
combination.
good marriage at the same time?
Yeah, right.
God.
I mean, it's a gem, right? It's like very because there's a lot of hunting that goes on in this community. We live on the water here, so a lot of like bird hunting, duck hunting, that kind of stuff. So yeah, they definitely cater to the local population. It's pretty interesting.
Well, let's get on. Let's get focused here and let's talk about the market, because I got you for 55 minutes and then I gotta sink in and solve lots of problems here. I got a lot of problems, you people. Gianni, being a professor is the akin to like flipping burgers at McDonald's. Really, it is, because you just can't make everybody happy. There's so much tedium to handle, and it's just my email box is always full with people who have problems. I feel like more of a psychologist than a professor. Needless to say, I'm going to say good morning and say hello to the usual suspects here. I don't want to go through the whole list, but you know who you are. Gianni and I know who you are because we see you here every day. So we acknowledge who you are. Rodney, Ship, Trains. Gianni knows you all too. We got 913 this morning, Gianni. I hope to get that up eventually up over 1,000 to 1,200 one day. That really kick it off. But let me just say good morning and welcome to the second hour of TheoTrade. You know me, I'm Professor Jeff Bierman. I'm joined by Gianni Di Poce, the Italian stallion. We could not be more opposites in terms of him being a momentum trader and me being a contrarian. But the one thing we agree upon is if you can't manage risk, you're never going to survive this business. You have no shot whatsoever. So
Yeah.
with that further, Gianni, let me give you a mindset here and let me give you fair shake to see what you think about this. Okay. So people, there's a cryptic meaning. It's cryptic, Gianni. So I even got to unload it to you because you're a little bit younger than me. The theme today is called on your screen, time in a bottle. So people say, where does time in a bottle come from? Well, it comes from many sources, but I'm referencing the folk singer Jim Croce. Gianni, do you know Jim Croce? Does that
I
say?
don't I don't know.
Okay, so Jim Croce has all these like songs that you hear in music. You're in a store with your wife and your kids, and it's over the loudspeaker and it's on
Okay,
low, but you never know what it is. It's kind of like
sure.
John Denver, but
Okay, yeah, I like John Denver. Yeah,
yeah, but
yeah, yeah.
it's Jim Croce. So Jim Croce wrote this song back way before he became famous, called "Time in a Bottle." He never got a chance to actually release this on one of his albums when he was out there. This song was released post his death. He was killed in a plane crash
Oh wow.
in 1973. It was obviously a tragic plane crash. So here's what Jim Croce looked like for those of you who are old enough. Gianni, of course, you're not old enough to remember, but that doesn't mean you can't appreciate where I'm going with this, because I think you're going to meet me halfway on this. There's Jim Croce, and he wrote the song called "Time in a Bottle." I need to go through the lyrics, so let me just give you the the colloquial meaning, because I know you're like a philosopher guy. You bring in Greek and you bring in tragedy. I love the elements you bring in terms of horoscope, because you'll appreciate this.
Oh yeah.
Time in a bottle was a phrase that refers to the desire to capture and preserve precious moments with loved ones. So in Jim Croce's song, it symbolizes the yearning to hold on to fleeting time, emphasizing the importance of cherishing life and relationships. So the long story short, the song conveys a timeless message about appreciating what we have while we have it, reflecting on the fleeting nature of life and wish to control and enjoy our passions. Now, the reason why I bring this up, Gianni, and you can run with it here, is this. I'm going to show you what I see, okay? And then you're going to tell me, like, give me your sermon, what you think has happened. By the way, I got short Coke this morning pre-market. It paid off very well. So I'm going to go with this. I'm going to show you a longer term look at this. Somehow my whole thing got messed up today and I have to reset it. So here's the 2-year weekly on this. I got to give myself space on the right. So I got to change the expansion settings to like 15. Pardon me for this. Something happened in computer in the reset, and I've got to reset everything. So here is the market as it were. And I want to draw the channels to show you what I'm seeing. So we kind of on the edge of that lower channel. So we're still at the edge of that algorithmic channel right now.
Yeah.
And when I look at the market, Gianni, this is what I see. I see for the next 4 weeks, including today, that it's time in a bottle. And people are like, what does that even mean? Number of reasons. We're in the high holiday season, right? We're in Christmas, Thanksgiving. So appreciate what you have. And I don't mean that in a market sense. Appreciate what you have with your families, because life, it comes and goes very, very rapidly. The people we love disappear, the friends go. That's one reason why I'm doing this. The second reason why I call this time in a bottle is, Gianni, this has been the best market I've ever seen. I've ever in my life. Nothing rattles this market because the market isn't made up of fundamentals or people anymore. It's made up of momentum, it's made up of liquidity, it's made up of machines, and it's made up of narrative. So what I'm telling all of you out there is take a look at the market now and appreciate what you're seeing, because I do believe starting in the first quarter of next year, this is going to disappear and go away for a very long time. I feel like we're at the very top of a liquidity cycle. I'm on board with Garrett Baldwin. I think when we get in a new Fed governor, because they're going to get rid of Powell, whether it's Hassett or whoever, it's going to move from a panic regime of micromanaging to one that's a little bit more laissez-faire and letting the market act on its own. And the third reason why I call it as time in a bottle is because I think between now and the end of the year, Gianni, the potential, the probability of the market going below 6,500 is zero. We're just going to trade in a sideways pattern as if it's like, time inside of a bottle. Like picture a bottle on its side and a ship is on its side doing nothing but moving sideways. I do believe the market is rigged, Gianni. I do believe that the rotations today is all tech. It's all tech. There's nothing but tech. Everything's getting crushed but tech. They're selling every sector but tech. So they're just like, it's like gaming the system. They're figuring out a way, well, what can we sell and buy to continually elevate this? So those are my 3 meanings of time in a bottle. Back to you.
Well, the
observation.
What's that?
Lot to digest.
Yes. So I agree with you. I don't think we're going to be below 6,500 before the end of the year. I think that we had that low. And that's when you and I were live together. What was it, like 2 or 3 weeks ago? It's hard to keep track of time. It just goes by so fast. But that was the exact line in the sand that we called out. We said, hey, you hold 6,500. You might chop. You're going to see a little bit of volatility, but that doesn't actually change the bigger picture. That breaks, you're dropping to 6,100. But we held 6,500, and we had the rebound right in the bottom of that algorithmic channel. So that's shows that's where the machines were looking at, and that's where they stepped up. Second thing is the tech leadership. So I have my cyclical model. Whenever you have a cyclical bottom, we had that bottom on the 21st of November. Whenever you come out of a cyclical bottom like that, you want to see tech lead. So this is exactly what I have been looking for. Seeing tech lead, seeing chips lead. This is normal. This is healthy. Tech is a leading sector. So it's going to lead now for a few more weeks. And then what's going to come in after? It's no different than how, healthcare and biotech had its little run in the sun there, over the last 6 to 8 weeks. Well, now we're rotating back into technology. To me, this is healthy. I think we can hit new all-time highs before the end of the year. Now, we're really not that far away. We're about 100 points away from that right now. If we do continue going sideways into year end and don't make a new all-time high, then I think that's actually building a bigger base for a sharp move to the upside in the first quarter. Could that be climactic? I'm what I'm looking at now, you could see some volatility, some serious risk creep back into the market as soon as February. I don't know how steep that would be in terms of a pullback yet. We'll have to see, where we, kind of are in the ballpark of topping out. But I love seeing tech leading. You're actually seeing chips do even better. So I like to see chips do better. So to me, this is pretty healthy, what we're seeing today. And you have a lot of seasonal tailwinds right now. I like this at the moment.
What is your forecast after December 31st, the first month? Do you see that when we peak, like we've had in 2022, 2024, and 2020, the market go into a 10 to 20% correction? Or do you think we actually have legs underneath this, both based on tech and financials?
Yeah, we have it's midterm year next year, and you usually get a steep correction at some point in the year. So I don't know if it's going to be in the first quarter or in the third quarter, but that potential is certainly there. And I think the bigger story is that coming out of those midterm lows, you usually see pretty big rallies. So I am looking for some serious volatility next year. I think it'll, because what happened this year, you had one serious bout of volatility when we dropped 20% in April. I mean, yeah, you had a little bit of sell side action for like 4 weeks there after the October high, but that was like a 6% correction in the S&P. So, next year, I think that you could see 2 double-digit pullbacks. I think it's going to be a wide range of trading, and it's going to be a trader's market. So I'm pretty excited for it, actually.
All right, so I'm going to toss this out at you because Don and I were kicking this around, and I don't truly believe that fundamentals really matter, Gianni, in the short term. I think they're useless. I think in the long term, they resonate, they make sense, but in the short term, it's too much noise, it's too much technicals, it's too many cross currents, it's too much liquidity, it's too much narrative, it's too much social media just messing your mind up. So that's why I can't listen to it. I'm going to throw this out at you. Okay. I'm just going to toss this out and you can run with it. So there was a survey done, and Don hates surveys. Some surveys to me are ridiculous. How many people do they interview? Like 500 people from Detroit? Or is it a cross section of demographics and whatnot? So they had this survey that was done of all the places in the world. FINRA, FINRA, right?
Oh, yeah, I'm glad I don't
The
deal with them
Financial
anymore.
Industry Regulatory Authority, FINRA.
They were always okay with me, but yeah, I've heard some horror stories.
Yeah, I was under the umbrella of FINRA for many years when I had all my licenses, which have all expired, but I could care less.
Yeah,
So
me too.
they run this what's called National Financial Capability Study. They run it what's called triennial over the summer. So they guess what it reported. Read the headline here. Survey says, right? Like, we're talking like, what's it called? A Family Feud. Survey says 26% of Americans are living beyond their means. And let me define what that means. It means they spend not a little bit, Gianni, but way more than they earn. Okay. Yeah. And that's up from a range from 2 years ago, because they do it every 2 years, right? So in 2024, the survey came out to 18%. Now it's at 26%. So they asked, well, what did that survey include? And the survey included 500 adult families from every single US state, including Washington, D.C., right? Yeah. And that's from a national representative. It was 25,500 in the entire survey, but it included, an extra 500. Usually it's 25,000, an extra 500 that they threw in there to see if it would change plus or minus the statistics, and it really had no impact. So my question to you is this. When does this make a difference to Wall Street, or will it never make a difference to Wall Street? Because Wall Street and Main Street are so divorced that Main Street will take us anywhere it wants to go. And when does Main Street push back on Wall Street and say, listen, we're going to start shorting and liquidating everything and dragging you down in the mud with us? What say you?
There's so much to unpack here. You look at the nature of the consumer, how it's evolved. Talked before about how the top 10% of households making over 250,000 a year account for 50% of the consumption in the United States. But I don't know how much of that survey takes that into account. Now you also hear stories about high earners living paycheck to paycheck and going spending beyond their means too. It really is incredible, an incredible thing to witness. But it made me think of this, like your notes over to me this morning, I came across something that was pretty interesting. It talked about how, some of the Black Friday data that we just had, how 95% of sales volume was financed. And
What?
about 2/3, 95% of sales volume was financed, and that includes credit cards, right?
Right.
And then 2/3 of that, people are not intending to pay that off within 30 days. And roughly $1 billion was spent using buy now, pay later models. Um, so, there's a lot to unpack here, right? Because you think about the nature of inflation, right? So first of all, I don't believe in spending more than you earn. I think that's really bad karmically, if you
Yeah.
believe in that type of stuff. I don't think that's good. I don't think that's good juju. But what I'm trying to get at is, you hear about all the stuff with inflation, right? And there is almost like an element of financial sophistication that you need to do this type of thing. But if inflation is real, it is, and if it is getting worse, and I think some of the evidence points to that becoming the case at some point, there is a good reason to have a little bit of debt, right? Because when you pay that debt back, you're paying it back with money that's worth less, right? So again, I'm not saying go out and spend more than you earn. On the contrary, but there's almost an art in like preserving some cash, investing it, taking advantage of the spread, the difference in interest rates. Because if you borrow money at 2% and you can invest it at 4%, people do that all the time in high level finance type things. So I don't think the average consumer is doing that. But people that tune into TheoTrade, I don't think they're looking to be like average consumers. I think they're looking to figure out like, you said this market's rigged, right? Well, so is accounting, so is like all of that debt, the way the debt works too, right? So
Mhm.
yeah, I think this buy now pay later thing going into this economy where inflation's not going away, that might not be like the worst tool to be used, wisely. The fact of the matter is most people won't do it that way. So yeah, it's like one of those things like just stay away from it if that's not going to be the case. But yeah, I mean, corporations do that all the time. They borrow $1 billion at 2%, investing it at something, that's paying 10% and generate a bunch of cash flow. That's kind of how they do it. So unfortunately, the average consumer is not doing that, but that's kind of how these tools are designed to be used properly. So yeah, um, I don't know how this ends, Professor. Americans love to spend. They're optimistic. They believe in the future. Warren Buffett always said, or was it Charlie Munger, never bet against America or whatever. All I hope for is that wages see a big bump to the upside, because that's really what it comes down to. If wages can't keep up, then this is not going to end well.
Well, I'm not against inflation. I'm against rampant inflation. You need
Yeah,
inflation in order to have profit margins and make money. So to
sure.
say inflation's bad is not true. Inflation's actually good as long as it's maintained and under control. What the Fed has done is they've completely mismanaged the entire economy by cutting rates to zero for 4 years, which is just stupid. Even I could tell you that, not I'm an economist. Getting
Yeah,
people to spend crazily overnight because of COVID, inflation goes up 35%, 30%. It's reset itself, and it hasn't reset itself back lower at all. So if you're asking the actual company whether they want to set prices lower, what do you think? No, their job is to make their shareholders happy and
yeah,
make their margins as high as possible. So to a degree, inflation's good, but this is the other side where it's not necessarily good, which leads me to my next point, because I'd spend the time doing a little bit of research. So I wanted to kind of flip the script here and ask you something. Okay, so the ISM manufacturing, it doesn't drive my thinking. I could care less. But there's that faction of people out there, the JP Morgans, the Goldman Sachses, the Morgan Stanley, where they'll actually they'll integrate this into their models, whatever, their weighted average models, and they'll say, oh, well, the ISM US factory activity, and this is, by the way, this is services, Gianni.
yeah,
It's not it's I mean not services, but rather manufacturing.
yeah.
It shrunk for the ninth consecutive month in a row. That's why I called Let's Get Small. That's actually a line from a show called Laugh-In from the late 60s, long before you were born. It's called Laugh-In. Look
Yes.
it up with Artie Johnson and Goldie Hawn. Let's say Artie Johnson say, let's get small, okay, because he act like a child. I'm asking you, like, if the ISM is shrinking for 9 months in a row, this is my question to you. Is the Fed, I mean, has the market got it wrong? Could the market be wrong? In other words, the market's so high on AI. Is AI not a part of the manufacturing dimension? Or is the economy itself really going down? Is this what the Fed's really worried about that makes them cut interest rates? Tell me how this factors in your thinking, because my thinking is, well, if it's down 9 months in a row, then why does the market keep going up? Shouldn't the market go up with the expansion in the economy?
Well, maybe the market's pricing in, more rate cuts because of this type of weakness, and so they're looking at more liquidity, looking at lower rates. But I will say this, I live in the Rust Belt here, and I mean the most robust factory activity I've ever seen in my lifetime. I'm kind of like, I was born after the golden age of manufacturing in America, but I'd say the most activity I ever saw was like 2017, 2018. I've never seen it as busy as I did then. So, you mentioned, is AI not part of the manufacturing landscape? I don't think it is yet. At some point, it will be. When you get all these robots and AIs running the factories and whatnot. But right now, I mean, it's just kind of chugging along. I mean, you got some, engine plants not far from where I live. I drive by them regularly. And they're running during the day, but during the night, they're quiet. They're not running 24 hours a day. I think the auto industry needs lower rates too. The consumer's feeling the pinch. And if you want people to start buying again, then you need more favorable financing terms. No one's buying a car outright in cash. And that was kind of the point I raised earlier, is like, when you have this inflationary environment, like paying cash up front is kind of like you're being a sucker. I hate to say it.
Yeah.
That's not how you do things. Like, for 20 years we were in a period of deflation where like paying cash made sense, right? We're not in that world anymore. So that doesn't mean go out and rack up 100 grand in credit card debt. That's not what I'm saying at all. I want to be very clear, because a lot of people say, oh, this is my license to go spend and borrow a bunch of money and not pay it back because of inflation. No, no, no. It's not what I'm saying. But like, if you're borrowing money for a rate of interest that is lower than the inflation rate, you are beating the bank. You want to beat the bank. You want to beat Wall Street. That's how you do it. That's how you do it. It's really that simple. It's like all the people that got, 30% mortgages below 3%, and now mortgages are 6%. Guess what? You beat the bank, guys. Congratulations, because all they're doing now is trading your mortgage in the secondary market because they got hosed on the value of that loan. You won. Good job. So same thing when, doing consumer spending. So yeah, the factory stuff, I don't know, Prof, is manufacturing like that big and that important, like in America? Like, we're in the Midwest, right? So like obviously it's a little different in this neck of the woods, but is that really what holds the American economy up in 2025? I don't really think so.
Well, it calls into question the data that the Fed spews out, because they come out with the gross domestic product, the GDP,
Yeah.
and a lot of these strategists are they're screaming, they're ballyhooing. We're going to get a 4.7 print. Well, first off, a 4.7 print on a GDP is terrible. It's hyperinflationary. You don't want that. You want a 2 print or a 2.2 print, which means growth with inflation in check. But here's the thing: if these people, these strategists are so how are they coming up with that GDP? GDP and ISM go hand in hand.
Yeah.
If
Yeah.
ISM is increasing, then GDP is increasing.
It's
What
AI
they're saying is
capex.
ISM's declining and GDP. How are they conflating this?
It's all AI
It's constant
capex.
lies. It's lies.
Yeah, well, I just said it. It's all these tech companies spending billions on AI. You've seen the data, right? It's literally, if there wasn't CapEx as capital expenditures, by the way, for anyone tuning in,
Yeah,
that's literally what's growing the economy. If you took out AI CapEx, what was it? The economy would be shrinking, or we would have grown like 0.1%.
right.
So it's literally like, oh, the Mag 7, it's a bubble, it's this and that. You realize that's what's keeping the economy afloat, right? Like that's the
Right.
only thing growing the economy. Everything else is still stuck in the gutter. And listen, I'm not an AI like tech guy. I mean, I use AI for like research. I don't use Google search anymore. That thing's been dead for years. I'm actually glad, I can like use AI and like run a search and get good information back toward me. But it's So yeah, you kind of addressed that when you answered that question, when you asked me that question a moment ago. AI capex is what's, become that. I mean, think about all the new data centers being built. Like that doesn't fall into the, I don't think that would fall into the category of the factory data. So like there is stuff happening. Here in Michigan, they're building another nuclear plant. They hadn't built a nuclear plant in decades. Like stuff is happening. It's just not in the old economy, basically. It's in the new economy.
Well, I'm going to join you. I don't agree with you a lot. I don't join you on this one. I don't see it. Look, there's different types of bubbles. There's a
Yeah.
valuation bubble. There's a liquidity bubble, right? There's a psychological bubble. I don't see AI as a bubble in like other people do. I see it maybe as a valuation issue, but I don't see
Okay.
it as like it's
Yeah.
just a bubble for the sake of being a bubble because it's driving the entire economy. So I'm
Right.
not anti-AI at all. I'm just telling you there's going to come a period of adjustment of mean reversion where the survive will continue to thrive and those that can't keep up and that are
Yeah.
lagged will
Yeah.
start and that'll even the playing field out. But I don't like when people say, we're in a bubble. Define what you mean by a bubble. And I see AI like actually keeping the economy afloat. The
Yeah.
problem is it's displacing so many people for jobs that are never going to come back ever, right? And so you better either become an entrepreneur or you might be an entitlement Nepo baby forever. And that could present a problem. So
Well, I will say this. I'm glad that I got to go through college without AI being a thing. And we talk about these entry level jobs. Like I did it too. Like my first office job was like data entry on tax returns at a local accounting office,
oh,
right? Like,
sounds sexy.
yeah,
Terrible.
it was what drove me crazy was when people would come into the office and like drop off a plastic bag of receipts, and I'm like, there's no way I'm doing this, for long. But at the time, you take what you can get. But so now college students have AI to help them with their homework, right?
Yeah.
We didn't have that, and so where do they actually? This is like a serious problem, right? Because and you probably encounter it as a professor regularly, like where do they develop those type of entry level skills, because they're not necessarily cultivating them or building them out with their homework anymore because the AI helps them. And now because they don't have those types of skills, there's no entry level job market available for them because AI is taking that away too. So yeah, I think there's really two paths, like entrepreneurship. What'd you say, the trust fund nepo baby? Is that what you
Yeah.
said? I guess so. If you have that, otherwise, learn to farm, learn to trade, learn to be an electrician. There's nothing wrong with that. I like to get my hands dirty. I still got calluses in my hands, like it's it's important, just have a skill and take pride in your work. That's really what it comes down to. But yeah, I mean the mindless jobs, I mean, I don't know, those entry level jobs that don't require like the highest level of technical skills. So then how do you break people into that higher level of technical, type of skill set? I don't know. It's going to be a challenge. It'll figure itself out eventually, but I don't know how you break into the industry now, without that type of, I mean, that's how I got into this business, Professor. I mean, like my uncle or my dad wasn't in the trading business. So, I kind of just did that whole entry level thing with like no skills, and, eventually you figure out a thing or two and you run with it.
Yeah, I'll call it, survival of the fittest. I didn't like my first job, but I found my way. So I couldn't agree with you more. This generation that I'm trying to teach. I don't indoctrinate, by the way, because I don't teach philosophy or ethics. Goodness
Yeah.
gracious, I'm just trying to teach them how to get a darn job. And most of them, not the grads, but the undergrads, it's like trying to talk a different language to people who are completely they're out of touch with what employers really want and need. So I could
Yeah.
go on forever and spew this, but let me get to my last macro point because this is where you're going to leave me in the dust. I'm not an international guy. Like I've been tapped by the university. Can you please teach this international finance class? No, no, this is not what I do. If I'm not an expert at it, I'm not going to delve into it and have to
Well, you should
force
take
my
it and then have me come stay with you, a couple times here and there,
yeah,
and
you
I'll,
want
I'll
to
be
work at
I'll be a
Loyola?
guest.
I'll get you in the door because I just got an email from like just 10 minutes ago from my boss going, I need your resume for the accreditation thing. And I'm like, okay. But you probably have a shot to get there. We have two international people. They're on their way out. They're a little bit dated and they have a hard time communicating. and they're in their 70s. So you might have a shot, but I don't think you like the pay.
No,
So let's talk about take a
I'm not.
hike.
I'm not going to leave Theo for that. If they can let me like do
No,
what
no,
you do, you
I'm
know.
not leaving Theo for that job either. I
Yeah.
just do it because it pays the groceries and it's almost paying off my mortgage. So yeah, my boss just said thank you. He's a real stud, by the way. Anyways, take a hike, Gianni. Not you take a hike, but let's talk about this. So you and Blake have your pulse on this, and I just don't.
Yeah.
Okay, and Brandon too. The Bank of Japan is pressuring the bond markets with another rate increase, but it's only 25 basis points. Not a big deal. I mentioned this yesterday, so I need you to run with this for a couple of minutes. There's interest rate parity, Gianni, interest rate parity, and there's purchasing power parity. I want to talk about interest rate parity. So the bond market itself, and here's our bond market you can see on the screen. It's heading down. Bond market is a proxy for inflation. If the bond market goes down, it means interest rates are going up. And if the bond market rallies, it means interest rates are tempered and they're going down. We are in a bear market. Gianni, don't play games with me. Okay, don't sugarcoat this because I screwed up on the time frame here, so I'll get it right for you. I'm going to go into the daily. I'm going to go in for about 10 years monthly so you can see this. See, I'm having trouble with I'm going to have to dry off my keyboard. I have like millions of keyboards here. My fingers are like dry and they not catching. So this is what we call a bear market.
Absolutely.
And this is a bond bear market. And you need to address this with the people on Theo. Are you buying this bond bear market, and how much impact will Japan have on us if they raise rates yet again for about the fourth time this year? Like, walk me through this.
Well, this is the canary in the coal mine, right? Bank of Japan is the only major central bank not easing anymore. You know, the Fed was
Yes.
late to the party. The ECB has been easing. Switzerland's back at zero. And that's still not stopping money from flowing into the Swiss franc. People are just saying, hey, you know, just take my money, Switzerland. I don't even want anything to do with, you know, what else is going on around the world.
Right.
But you know, the Japan question is it's a deep one, and yeah, so I have actually been taking a bit of I'm taking a page from your book, a bit of a contrarian approach on this. I think the Bank of Japan is going to surprise us and pivot and ease next year. I really
Really?
do. I think they're gonna. I think that's the kind of like the trump card for the global central banks. And here's why. Like you hear Scott Bessent, you hear the European Central Bank talking about how we have, you know, serious debt problems relative to GDP, relative to economic growth, and that is all totally right. And we all know that the government's broken. We have no way to pay our bills. Okay, well, the situation in Japan is a lot worse. So I always tell people, you think the US is bad, you think Europe's is bad. Japan's debt to GDP ratio is like, I don't even know. I mean, is it like 300% still? It's something like absolutely insane. So this isn't going to go on forever. At some point, the Bank of Japan is going to pivot again. You'll notice that even though the Bank of Japan is threatening to raise rates, it's not really stopped the dollar yen from going up. The market is calling the Bank of Japan's bluff. They're saying you're full of, you know what? You're full of crap. You're not going to keep raising rates, the Bank of Japan. You're not going to do it because your government is more broke than America's, it's more broke than Europe's. You're not going to do it. So this is the big bluff that's being called because even today, you know, you had that sell off in the yen or the dollar yen for like what, 2 weeks. You hit a new low yesterday, you're already back up higher today. The carry trade is still alive and well. And even with the Bank of Japan allowing rates to come up, they're still significantly lower than both Europe and the United States. So whether you look at the cross pair between the euro and the yen or the dollar yen, the yen has been losing value since April. Okay. Again, because the market is calling the Bank of Japan's bluff. I believe the market. I don't believe the Bank of Japan. Even if they hike again, you know, this week or next week, I think it's going to be the last one. I think it's going to be the last one, and we're going to see a giant bazooka, to borrow a term from Brandon, of stimulus coming next year. And you're right. You know, you said the GDP print is probably going to be too hot. You don't want to see it, you know, north of like 4%, close to 5%.
Not
But
good.
if you ever want any hope of the debt situation from the government becoming manageable again, because right now it's completely out of control. This is what has to be done. And this isn't a trend that's going to go away next week or next month. This is going to be in effect for years, decade plus. So you better learn how to operate in an inflationary economic environment. It's not going away. You mentioned the thing in the bear market in bonds. We are in a long-term bear market in bonds. The trend has flipped. So all the rules that you learned from 1980 to 2020, throw them out the window, because we're in a different world now. We're in a different world. That being said, I do think that bonds you could theoretically rally like into next year a little bit, but the long-term trend is down. Like you're not buying these bonds to hold to maturity. There might be a trade on the bullish side of the market. In other words, rates could come down for a little bit, but they're not going to stay down. If anything, it's going to blow, the inflationary bubble even greater. So yeah, I think the market's calling the Bank of Japan's bluff, and they're not going to keep raising rates. This might be the last time they do it.
Well, my point is this: I don't think the market cares about rates. I think rates have become like almost on the back burner. Like rates, what's that? Markets used to be driven by interest rates. They're not driven by interest rates as much. The market's come to normalize. It's anesthetized and saying we can handle 4%. This is a 30-year in front of you. That's a 4.7 handle. The market's telling you we can handle a 4.7% and still grow. We can handle 5 and still grow. We are not at the point, that prohibitive point that says above and beyond this, the market's in trouble. I think interest rates have become a secondary story. I think the Fed and their interest rate manipulation is a secondary story. I think it just comes down to liquidity, that they're willing to pump liquidity in the market constantly, and the rates don't really matter all that much anymore. All I know is at the end of this year, I don't see our market not even tick, Gianni. I'd be surprised to see if we tick below 6,500 for 5 minutes. 5 minutes, 1 minute, 10 seconds below 6,500 level. I just don't think it's going to happen. I think this will be the third consecutive year we're up. I think Wall Street knows it. And I think Wall Street's going to play to the window dressing hand, and they're going to say, listen, market's up again. Place your bets. Give us another $1 million. This is going to allow all the brokers on Wall Street to suck in more money and try to sell that story. I think 3 years in a row of double-digit returns is probably the end of it. But let me switch gears here, because
setting a bad precedent, is it not?
Yeah, let me switch gears here with Tesla, because we got 20 minutes left. So Michael Burry's in the news again. He's out there again, Gianni. You can't escape it. Burry came out. I call it Burry slurry. Burry came out, and he's bearish on NVIDIA, which is fine. I don't short NVIDIA because it's a sacred cow. I don't short Tesla because it's a sacred cow. But Burry's saying that NVIDIA's valuation is so detached from reality that he says this is the greatest short of a lifetime, even greater than NVIDIA. Now, you see the stock down today. I don't think the market pays attention to Burry that much. Do you agree with Burry, or would you double down here, or would you wait for it to correct? Or do you think that Burry could actually be right and for instance saying, hey, look, at a 293 handle, which I don't believe is correct, I think it's more or less about 100 handle, that, and I'll do the numbers in my head. It's just $2 divided. It's about 210, 220 is the PE, which implies a 200% growth rate. Is Burry right, or is he out of context? And do you own it? And are you still positioned in it?
Yeah, he's completely wrong. Completely wrong.
Defend your case.
Well, my case, I'm a charts guy. I'm a technicals guy. If you want to get into like the storyline behind it, Elon's got the robots. You got the whole Optimus thing, that humanoid robot. He's going to have those building his cars. This thing's more than just a car company. He's got the AI, he's got the battery storage. This is a company that, if we were talking about like the futuristic economy, this is a company that pretty much encompasses all of that. My target for Tesla is like $700 for next year. I think this is going to be the stock of the Mag 7 for 2026. I don't even think NVIDIA is going to be the main event anymore, or the main character, I should say, in the Mag 7 going into next year. I think the main character is going to become Tesla, and I'm bullish. I'm long. I'm not just like talking my own book here. I mean, like, I put my money where my mouth is. Like, I'm long. And so, that doesn't mean that we're going to hit 670, next week. That's not what I'm saying. I'm saying, like, I think that's a target next year. And you've been building out a beautiful base. The stock hasn't even hit a new all-time high in 2025. Think about that for a minute. Every stock in the Mag 7 has done well this year, really, except Tesla. Stock's done nothing all year. We're talking its all-time high was formed on December 18th. So if you believe in value, if you believe, I shouldn't say value, I should say if you believe in rotation, if you believe this bull market's going to continue, well, then you're gonna see money flowing to Tesla. So that's how I'm positioned. Again, like we have a swing long open on NVIDIA here too, but it's not like my target on NVIDIA is only like 230. It's not really that high. So yeah, I think he's completely wrong on Tesla.
Okay. I don't trade Tesla. It's not good for my health. And I also don't like to bet against Elon Musk. And there's a group of Teslonians out there who every single time you go to attack it, they will be there to circle the wagons and
Yeah,
try to bring that stock back. So I try to stay away from it. I just want to get your take on it. I know Garrett Baldwin has a similar perspective to you. Like, you can't value the company on traditional metrics. It's nonsense.
yeah,
I tend to agree with that, but I just don't see Tesla as making the bulk of their money in cars. It's got to be their alternative technology
yeah,
and
yeah.
some new market or disrupting that he's working on that will change the face of the planet. The next one, I wanted to skip to the third one. I call it carrying the load. I'm going to drop a stat on you. I'm not sure you know this, but I think it's good for you to know. Did you know that the S&P this year, and we'll bring up the S&P 500, not the E-mini, but the S&P 500, and I'll bring it up year to date so you can see it. Time frame, daily. You can see I'm struggling here because my finger, it's like, again, 10 year, a 1 year, year to date, daily. Sorry about this. My system erased everything. I have to reset everything. It's taking me hours. So
Yeah, it's
here's the
frustrating.
S&P 500 year to date. Let me bring to you the style on this because I think somehow it erased a lot of the stuff I had. Yeah, I have to add it back, but I'll do this here in front of you. There is what we call a percentage time axis, a percentage price axis. So you can add show price as percentage, which I'm going to do right here.
Okay.
Hang on. There. Struggling to do this because it's again so dry. All right. So I apply it. So the S&P is up 16% this year. Got it?
Yep.
Did you know that of that 16%, 1/3, 33% is concentrated in Google and NVIDIA, two stocks.
Believe it.
Okay, so
I didn't know that specifically, but I
so
totally believe it. Yeah.
5.13% of the gain is two stocks.
Yeah.
That bother you? Does that worry you about when a correction comes? Or would you call, because that Don would define that as a bubble. How do you define it?
Well, I mean, you can make an argument that a stock like Google is in a bubble, right? I mean, the stock has more than doubled since that low of April. But and I guess that's kind of part of what feeds into my bullish thesis on Tesla is I think Tesla's going to have a similar move next year. And we've seen situations. I mean, even look at Apple. Apple had done nothing for most of this year, and now it's hitting new all-time highs. But it only started hitting new all-time highs like back in October. So you get these rotations within the Mag 7 periodically. I mean, look at Meta. Meta dropped hard. Meta dropped from almost 800 down to 580, and the overall market kept going higher. So that's why we need to see that rotation. You need to see a stock like Tesla assume type of leadership if the bull market is going to stay alive. What this does do is that it exposes us to concentration risk, and then when these stocks all roll over in unison, it's going to bring the whole market down. And you actually saw something similar play out in the dot-com when the dot-com bubble burst. You had those high-flying tech names that brought down the Nasdaq significantly more compared to the S&P or the Dow. But the average stock actually held up significantly better than a lot of those high-flying tech names. And there really are a lot of similarities between now and then if you study the tape and study the price action. So I do think that at some point it will create, I think, actually difficulty in index style investing.
Oh God, yes.
It's going to create a lot of problems for people that like to dollar cost average into their portfolios and just buy ETFs and just put money into their 401k and not really think about it, because that's all that's all they own. You put money in your 401k, you're buying Apple, you're buying Google, you're buying NVIDIA, whether you know it or not. And it's been the gospel on Wall Street lately, like over the last couple decades, like, oh, just dollar cost average and passive investing and buy ETFs and individual stock picking and active management is just bad. It's wrong. Well, it's all a cycle too, right? At some point, that's what's going to actually help you weather the storm. Once the Mag 7 rolls over collectively, you're going to want to have stock picking skills,
Yep.
because there will be things that are moving. Maybe it's gold stocks, maybe it's Coca-Cola, maybe it's consumer staple stocks. But you better be comfortable buying those not so sexy type of names if you want to get returns going forward. It's just not going to be the high flying stuff in the Mag 7. You have to adapt. You have to be able to identify that. So yeah, it'll be a problem eventually. Absolutely. And it's going to challenge a lot of what has been repeated like ad nauseum on Wall Street. Just dollar cost average into these low cost ETFs and never look at your portfolio. It's going to work until it doesn't.
It comes in cycles.
Yeah.
Once the cycle works against you and you dollar cost average into ETFs, it's going to kill you. It could be the pin that bursts your bubble. So I couldn't agree more. I'm concerned because I mean, when two stocks control 33% of the gain, that could also spell trouble, not just for indexing. It could spell trouble for antitrust. The government's like, okay, they're wielding too much power. Justice Department walks in and goes, let's break this up. And the next thing you know, NVIDIA is down $75. It could happen. I'm not saying it will, but it could.
Absolutely. Well, historically, that type of stuff happened before. Usually that type of stuff happens when, you get too much wealth concentrated in a select few. I mean, you look at the trust busting of the early 20th century.
Yeah.
That was actually before the Great Depression, but then, you had some other stuff happening, after that time too. So yeah, interesting history for sure.
Yeah, I've got like 10 minutes left. I wanted to go to your child, Gianni, your love child, MicroStrategy, Mr. I call it Mr. That was, by the way, there was a group on a band, a pop band called Mr.
Yeah.
Anyways, I call it now or never. Now or never on this. So Don spoiled my fun. He always does that. He does it on purpose, by the way, to steal my thunder all the time. So MicroStrategy has been, and I did an interview, and I got a lot of emails from the people. I did an interview for Market Watch and Barron's. So what do you think of Bitcoin? And I said, I think it's in a bubble.
Yeah.
I said, and this was when they asked me on the beginning of October. This was way over here, right up at this level. I did the interview October 2nd, as a matter of fact. And I said, well, it could go higher, obviously. I said, but ultimately, I think things going to find itself back at 80,000. And I said, this could be the linchpin that could break the back of the market. Well, guess what? I was right and wrong. It did. The stock did break, but it didn't break the back of the market.
Right.
Now Michael Saylor's screwed. Apparently, he dollar cost averaged into 8,196 Bitcoin contracts at an average price of 102. So it just goes to show you that it's not just Saylor. Any insider is usually a bad market timer. And he loaded up at 102. So now it's down to, and I'll take off the prices percentage. And you can see for yourself, it's down to 90,000. It's getting a bump today. It's volatile. It's 5,000 bump.
Yeah.
Are you still just as bullish on this? Would it change your mind if this went into a multi-year bear market, or would you still hold on through this? Or do you still own it? Is my question.
Well, no, I mean, I don't hold anything like religiously. I've been stopped out, a couple times on this pullback. There is a possibility, Bitcoin could test 74, 76,000 here. But we're going to see how we react to the rate cut next week. I mean, stocks coming out of this low look pretty compelling. By the way, great call on that $80,000 target, because that actually was a really good target based on the breakdown you had from that topping pattern. Could 80,000 be the low? I mean, in theory, what would I need to see to say, okay, Bitcoin has bottomed. Well, you'd have to get back above like 108,000. That's quite a distance away. This is where it gets tricky, right? Because that would actually be a higher high. You'd have a signal that the trend is starting to change and turn bullish again. So I have started to dip my toes a little bit back into crypto, not through MicroStrategy.
Mm-hmm.
Um,
And
but
what alternative way are you dipping your toe?
well, I've been nibbling a little bit on like Ethereum and Solana. You can actually pull up Solana SOL. They have it in the futures now too. Um,
This
no, forward slash
forward slash
SOL.
or so. Okay, I'm sorry.
Yeah,
Solana.
yeah,
Okay.
yeah. But so dipping my toes a little bit on that because you don't need to put a lot of money to work, to where if you're right, you can make a good amount of money, and if you're wrong, like you're not really like gonna cause some long-term issues in the portfolio. So that's kind of how I've been dipping my toes back in. Then you got a couple of those like Ethereum treasury companies I've made some small allocations to, but yeah, it's a tough call. You could still fall to like 74, 76,000 in Bitcoin, maybe even Ethereum around 2,200. But you got to start taking out those highs from before to say, okay, we're all clear. The problem is that would be like, another 20% rally, and then you missed out on a pretty sizable chunk of the move when you wait. So this is where, you and I always say we agree a lot totally on this. The risk management comes in. You want to dip your toes back in the water. You don't need to put a lot of money on the line in order to make a big impact on your portfolio in terms of position returns. So sizing your positions is a real art
Oh yes.
in this business. So
Is it not?
yeah,
Oh my
it's
God.
yeah, absolutely.
This is just me talking out loud. When I position size, Gianni, I know this kind of may sound strange to you. When a stock falls against me, I
Yeah,
don't dollar cost average lower. I don't.
no, neither
But
do I.
when I dollar cost average into a winning position on the long side, I tend to stagger and trade really small.
Yeah,
But on the short side, I tend to take larger positions by about a 2-to-1 ratio. Do you know why I do that?
why?
Because psychology tells me that fear is stronger than greed.
Yeah,
So,
it is. It
so
is.
I have made up most of my gains this year by overweighting the short side in the Genesis cog and
Yeah.
underweighting the long side, and it's paid off masterfully. But that doesn't always work, but it's worked this particular year. I have a feeling that come next year, those who overweight in the short tech trade are going to find themselves very wealthy. I think this year you had to underweight the short side and just cop out when it's not working. But I have a feeling with volatility going up and the market is overbought
Yeah.
and the liquidity changing in January, I think you have a better shot over leveraging on the short side. But as it stands now, I'm split evenly. I have the same number of short positions as long positions. I just want to let you know that.
Well, if tech does roll over, if we get a market correction, you do see tech lead to the downside. That's the nature of the tech sector. It is a
Mhm.
leading sector, not just to the upside, but to the downside. So let's say you get a 20% correction in the S&P 500. Chances are the tech sector is going to be down 30%. If you get a 30% rise in the S&P 500, chances are tech's going to be up 50%.
50%.
So that's the nature of tech. So yeah, we're here talking about a couple bouts of volatility in 2026. Yeah, I mean, there's going to be some short side opportunities in the tech sector, regardless. So yeah, it's I can't disagree with you there.
I mean, I just took a short in Coke this morning, and I didn't get a chance to do it as an alert on the Genesis cog because my portfolio, the model portfolio only allows 10 positions at a time.
Okay.
I'd have to exit one to get in there. But this
Yeah.
is like people say, like, well, how do I do it? This is how I do it. Look, notice, Gianni, how I wait until the channel's broken.
Yeah.
That's
Yeah.
that's
Yeah.
an art. That's not a science. That's an art.
Yeah.
And then the science becomes the indicators. But I had to wait to get past the dividend because if I short on the dividend, I have to pay that. So
Oh
I
yeah.
waited for it to
Right.
break, and people are like, well,
Yeah.
why are you shorting this? And the answer is simple. You can't justify a 23 multiple on a stock that's growing at 5%. It makes no difference. Now take
Yeah.
that logic and apply it to Tesla. You can't. Gianni, there's something that they teach in like the books and the Bodie Kane and Marcus books. It's a faux pas. You cannot ever cross compare two industries. If you do,
Yeah.
you're fired. You're like your job. You are fired in the industry. Don't say, well, let's look at technology. Let's look at ExxonMobil. Can't do that. You can
Right.
never cross compare different business models in different industries. So for me to short Coke at 72 in the pre-market, I can get away with that. Okay. You can't do that with tech because tech's a different animal altogether because tech can bounce against you. So valuation has so much less of an impact.
Yeah, 100%. Because tech, when it comes to tech and growth, you're pricing in, it's all about pricing in the future impact of that technology. It's not so
Right.
much about earnings. I mean, you think about even during the 2010s, Apple wasn't profitable, Amazon wasn't profitable. Imagine that, and that was actually kind of like my aha moment that made me more of a chart oriented trader. It's because when I got into the business, I was all about the fundamentals, and then it was always like, oh, don't buy Amazon, don't buy Apple because they have no earnings and it's a bubble. Well, those stocks, I wish I would have been buying them in the early 2010s, honestly.
Yeah.
Because that's when they weren't making money and they ended up making a lot of money. So that's what you're dealing with when it comes to tech. So don't forget that. Yeah.
All right. Well, so we're coming to the end of the program. We got to turn this over to Brandon. I got to do a Genesis cog at 11 o'clock today, and I got to jump into. I got grading like it's the week from hell because I have two separate classes, grad and undergrad, who come together on the same day for me to
Oh,
have to
wow.
grade the last sets of homework before the break, and then I got a final exam next week. So I got to jump. But is there any parting thoughts you want to throw out to the people here, like buy this dip, or just say, listen, the market ain't going down the rest of the year because I don't think it's going down the rest of the year. The S&P.
I'm calling this BTFD December. Buy the friggin' dip December.
All right,
So that,
I can go. I understand that. I'm just saying that I look at my portfolio today and my long shorts positions are killing it, and the
yeah,
longs are being absolutely trashed because they're defensive positions and valuation doesn't mean anything. Rotations have taken over the market. Like I've
yeah,
never seen a
yeah, it
market where
is.
fundamentals mean less more than they've ever meant, and that's disturbing to me, and that worries me about the markets long term. So
That's why we call them fundamentals in 2025.
fundamentals. All right. Anyways, Brandon, make yourself appear so we can say goodbye and you can take the run from here.
Hi,
I'm
Brendan.
here. What do you guys
He's
see
here.
about Sam Altman saying, "Hey, we got to kind of abandon our initiatives in advertising because we need to make our models better. We're losing
Good,
ground."
good, good.
It's kind of interesting, right? I mean, we
Yeah,
talk about all this AI investment. What's it for? It's all the source is Chat GPT, and if they can't advertise, they can't raise revenues. I mean, how are they going? This is going to get interesting.
It is.
yeah,
I'm with Gianni. Gianni, if you can't survive, then you die. It's like social Darwinism. Either
yeah,
you,
it
you
is.
figure out to adjust or you roll over and die. Too bad. That's what I call it.
Yep, I'm
Don't
with
look for
you.
the government to Brandon. Don't let the government and Powell bail you out. Sorry.
Yeah.
Don't want that. I saw in the chat, Zim says it. I just want the Fed abolished. Brandon, if the Fed were abolished, I'm going to celebrate. I'm the happiest guy ever because that just opens up the market to a two-way market and makes the algos less impactful. That's what
Well,
I
and
say.
that's the thing. In a free market system, there is no Federal Reserve, right? Interest rates are not set by a central body,
Exactly.
right?
Thank you.
We're talking about socializing gains, privatizing gains and socializing losses. I mean, that's not a free market system, but this is the system we have. And yes, they will bail the biggest companies out. So
Yep,
we got to understand that that is a reality.
yes.
All
Yeah.
right, Gianni, it was a pleasure. I got to jump. Brandon, take it from here. Gianni, see ya.
Hey, we'll
Thanks.
see ya.
See ya.
Have a good one, guys. All right, let's get rolling. Let me